Dealing with compensation and taxes after you buy a business can seem like a daunting task, but the LLC structure is used by millions of businesses every year. With some clear guidance, a little bit of understanding, and these easy-to-follow practices up front, you'll be set up for success and avoid setting up bad habits before it's too late. Hi, my name is Barry Young, and I'm a partner here at GWCPA. In this video, I'll be cutting through the confusion to provide you with some clear understanding of the easiest business structure you can use to acquire a business. One buyer, one seller, and an asset sale. By following the simple steps that I outline in this video, it's my goal that you would achieve financial success in your new business and avoid becoming another statistic of financial mismanagement. This video, we're going to be talking about a single member LLC. This is the term for an LLC that's only owned by one person. And with all my videos, please consult your own tax preparer or CPA for your situation, as state laws may differ. Some of the characteristics of an LLC that we'll find is that it's filed on your own 1040 on Schedule C. You also do not have owner payroll and the traditional W-2 sense. And the last characteristic is that the taxes are paid by the individual under their Social Security number and not by the company. In the case of an asset sale, you're actually going to be starting your own LLC in your state, and you're going to be acquiring the assets of that company. So one of the things that's important to understand about an LLC in this sense that we're talking about, a single member LLC, is that this is a distinction at the state level. It's a legal entity set up by your state. It's not actually a entity structure at the federal level. For federal tax purposes, an LLC is actually considered a disregarded entity, which means that the IRS does not consider it a separate entity. It's disregarded. It's actually filed on your Schedule C. One key that I want to bring up here is that it's important that you start an LLC in your state. If you register an LLC in Delaware, for example, and you're a resident of Maryland, you're going to be filing an LLC in Delaware, and you're also going to have to file as a foreign LLC in the state that you actually reside in. And if you are a virtual business or if you provide remote services to your clients, all of that income is probably going to be in the state you reside in anyways. The last piece I'll talk about here, setting up your LLC, you also want to go onto the IRS website and apply for an EIN. This is an employer identification number. It is required if you plan on having employees. It also shields your Social Security number from being your primary legal identification number, which you'll have to give out to vendors and customers in the course of your business. And so I recommend going on the irs.gov website. It's free to apply for an EIN, and it doesn't take a couple minutes. They'll give you an EIN right there after the electronic application. So one of the most pressing questions when you start a business or when you acquire a business is, how do I pay myself as the owner of this business? There are actually 4 ways that you can compensate yourself through that business, and I'm going to talk about those now. The first way you can actually pay yourself is just by paying personal expenses out of the business account. Anytime you pay personal non-deductible expenses through an LLC, they're not deducted for federal tax purposes, and so that money is effectively a distribution to you as the owner. I do not recommend this method. It actually can break down some of the liability protection of that LLC, but technically for tax purposes, it's the same effect as if you take a distribution to pay those expenses. It causes it to be messy, it makes bookkeeping a headache, and it will slow down tax time as your CPA is asking you about every single little charge if it's personal or business. So I do not recommend that method at all. The second method through a single member LLC is to actually just pay yourself anytime you need money. You need $200, transfer $200 out of the business account into your personal account, and that's how you pay yourself. The third way to do this is to set up your distribution, especially if your company is cash flowing regularly. You set up a distribution into your personal account every 2 weeks, once a month, every week, whatever the need might be, for a set amount, and you just have that amount go into your personal account on a regular basis. This fourth method isn't actually a way of paying yourself, but it's something that I do want to point out. A lot of people think if I don't pay myself, I don't have to pay taxes, and that's not true. With an LLC, you are paid on the income of that company, whether you pull it out of the company or not. So first I want to cover, how do we pay taxes? So like I said earlier in the video, your taxes are actually paid under your Social Security number. You're going to be paying these at irs.gov and then also at your state websites. These are going to be paid under your Social Security number, even if your company has an EIN. They're technically paid under the primary Social Security number of your tax return, your 1040 tax return. I've already said that you pay these federally on irs.gov. You can still print out a coupon. It's a 1040 ES coupon, and you can print that out and you can mail it in. I do recommend electronic payment. It's fast. You can schedule it up to 365 days in the future on the IRS website, and you have a record when you log into your account to see that those payments have been made. All right, how much to pay? So what I want to talk about here is you're actually paying income taxes at the federal level, and then you're also paying self-employment taxes. So when you are an employee, you pay Social Security and Medicare. It's 7.65%. It comes out of your paycheck. You don't even notice it. Your employer also matches that percentage. So an additional 7.65% that they pay on top of your compensation. When you are self-employed, you get to pay the full 15.3%. It's called self-employment taxes. Once you get to the Social Security ceiling for the year, in 2023, it's around $160,000. Once you get to that level of net income within the business, then you're only going to be paying the Medicare portion above earnings above that amount. But for federal purposes, you are paying your income taxes and your self-employment taxes at the same time through that quarterly payment. For state taxes, you're most likely only paying state income taxes, again, on a quarterly basis. Estimates are also due quarterly. So I wish I could say every 3 months. It's not quite that schedule. It's April 15th, then 2 months later on June 15th, then 3 months later on September 15th, and then 4 months later on January 15th. So the fourth quarter estimate for this year is actually due January 15th of next year. They do that so that they allow you to be able to wrap up the year before you make those estimated payments. All of these payments are then reconciled on your 1040 at the end of the year. So you're going to have your total household taxable income, your total household tax. It's going to add in your self-employment taxes to give you a total tax number. And then it's going to reduce that amount by any withholding that you've had from W-2 sources, from any estimated payments, and any credits that you might have. And then it'll come to your balance due or your refund. Fun note for anybody who's self-employed, welcome to owning a business. You no longer actually get refunds because your first estimate is due April 15th. And so for most of our clients, we just apply any overpayments forward for the next year's estimates. So how much should I pay in taxes? I will say that tax planning for an LLC is complex. It does get involved because there are other factors such as rental properties, W-2 wages, credits that you might have for the household, withholding from other sources. There's a lot of stuff that goes into tax planning for a small business. But my general recommendation to any client that I have that is new to being a business owner is to put aside 40 to 45% of the net of what you earn into an account for taxes, and do this for the first couple years. Once you're comfortable with the net income of your company, you're comfortable with this rhythm of quarterly estimates, there are safe harbor provisions that we will typically set up for clients that we're not actively doing tax planning for on a quarterly basis. Safe harbor provision is either 100% or 110% based off of your income level, 100 to 110% of last year's tax. If you at least pay in that amount, it will reduce the penalties that will be due when your taxes are actually filed. Just know that this is a safe harbor to avoid penalties. It's not an actual prediction of what your tax balance is going to be. So we've gone over compensation and taxes for a single member LLC. If you're interested in learning how you can restructure your business by becoming an S corporation, including times that it might not be appropriate for you to become an S corporation, you're going to want to watch this video next.